Every country on Earth is in debt. The United States owes $38 trillion. Japan owes $9 trillion. The entire planet owes $315 trillion, 3 times the size of the global economy. But here's the question that should keep you awake at night. If everyone owes money, who exactly is owed? The answer isn't some shadowy cabal. It isn't a single person, or even a single institution. The world owes money to itself, and that's not an accident. That's the design. Over the course of 3 centuries, 4 men built a financial architecture so sophisticated that you live inside it without ever seeing the walls. They created a system where debt can never be repaid, where governments borrow forever, where interest flows eternally upward, and where the people who designed the trap profit from every payment, every crisis, every bailout. This isn't conspiracy theory. The meetings happened. The contracts exist. The mechanisms are public record. You can look them up yourself. And once you understand how they built it, you'll finally understand why that $38 trillion debt isn't a problem to be solved. It's the system working exactly as it was designed to work. Let me show you the 4 architects, the 4 moments when the debt trap was engineered, and why every government on Earth is now caught inside it with no way out. The story begins in London. In the year 1690, England was at war with France, and King William III faced a problem that would have been familiar to any medieval monarch. He needed money, lots of it. Armies don't march on enthusiasm. Ships don't sail on patriotic speeches. War requires gold, silver, hard currency to pay soldiers and suppliers. But the royal treasury was empty. Tax revenue couldn't cover war costs, and traditional lenders were refusing new loans because, well, England had defaulted before. When kings can't pay, they don't pay. It's one of the perks of wearing a crown. Enter William Paterson. Paterson was a Scottish merchant with a checkered past. He'd tried and failed multiple times to get rich through various schemes. He'd promoted colonial ventures that went nowhere. He'd been involved in questionable trading deals, but in 1691, he had an idea that would reshape civilization itself. His proposal was elegant in its simplicity and revolutionary in its implications. Paterson would organize a group of wealthy merchants to lend the government £1.2 million. In today's money, that's roughly $300 million. A massive sum. But here's where Paterson's genius showed itself. The loan would never be repaid. Read that again. The loan would never be repaid. Instead, the government would pay interest forever, 8% annually. Every year, for eternity. To manage this arrangement, Paterson proposed creating a new institution. He called it the Bank of England. The mechanics were revolutionary. The merchant lenders would give their gold to the Bank of England. The bank would lend it to the government. The government would pay interest annually from tax revenue, and the bank would distribute that interest to the merchant lenders. But the principal, the original £1.2 million, would never come back. The loan was permanent. Now, you might ask, why would anyone accept a loan that would never be repaid? The answer reveals the first key to understanding the modern financial system. The interest payment was guaranteed by Parliament. It was backed by the government's taxing power. As long as England could tax its citizens, the interest would flow. The lenders had essentially purchased a perpetual income stream. Think of it as buying a river of gold that never runs dry, as long as England exists. But it gets better. The banknotes the lenders received in exchange for their gold could be traded. They were as good as money. Better than money, actually, because they paid interest. You could hold gold in a vault where it sits and does nothing. Or you could hold a banknote, backed by the English government's promise to pay you 8% annually. Parliament approved Paterson's scheme in 1690. The Bank of England was chartered. The merchants provided their gold. The government got its war funding. And for the first time in history, national debt became permanent. Not a problem to solve. A feature of the system. Here's what nobody explains about why this was brilliant for the bankers. The government paid £96,000 per year. Every year. Forever. The merchants had essentially bought an annuity from the government. As long as England existed, as long as it could tax its citizens, the money flowed. And if any merchant wanted their gold back, they could sell their banknotes to someone else. The debt was transferable but never repayable. But Paterson's real genius was what came next. The Bank of England was given the right to issue banknotes backed by the government's debt. They could print paper money up to the value of the loan. This created money out of debt. The government's IOU became currency. And the more the government borrowed, the more money could be created. This is the template. Government borrows, never repays principal, pays interest forever. And the debt itself becomes money. It's brilliant if you're a banker. It's catastrophic if you're a taxpayer, because you're paying interest on debt that will never disappear. Within 50 years, every major European power copied the model. France created similar arrangements. The Netherlands formalized their government debt issuance, and by 1790, the newly independent United States adopted the same system. Alexander Hamilton, the first Treasury Secretary, explicitly modeled America's financial system on the Bank of England. Permanent. Debt, interest, paid from taxes. Bonds traded as currency. Paterson himself died in 1719. Not particularly wealthy, despite creating the Bank of England. The institution outlived him by 3 centuries and counting. British government debt has never been paid off. It's been refinanced, rolled over, expanded, but never eliminated. The debt trap was set in 16, and every government since has walked into it willingly. But a trap is only as good as its ability to hold what it catches. By the early 1800s, European governments had embraced debt with enthusiasm. They borrowed for wars, for infrastructure, for operating expenses. The system Paterson created was working exactly as designed. There was just one problem. There was no organized market for all this debt. Each loan was negotiated individually. Interest rates varied wildly based on the monarch's reputation and the lender's desperation. Only the wealthiest merchants could participate. Buy-in government debt required connections, inside knowledge, access to royal courts. Nathan Rothschild changed all of that. He industrialized sovereign debt. The Rothschild family started as money changers and traders in Frankfurt's Jewish ghetto. Major Amskil Rothschild, the patriarch, had 5 sons, and in a move of strategic brilliance, he sent each son to a different European capital. Nathan to London, James to Paris, Amskil remained in Frankfurt, Salomon went to Vienna, Karl to Naples. 5 brothers, 5 cities, 5 banking houses, 1 family. This network was unprecedented. They could move money across borders faster than any government. Information flowed between the houses through private couriers. When Paris knew something, London knew hours later. When Vienna made a deal, Frankfurt adjusted before competitors even heard the news, and they used this network to dominate sovereign debt. Nathan Rothschild in London was the strategic genius of the family. During the Napoleonic Wars, Nathan arranged loans for Britain, but his real innovation was how he structured them. Instead of lending directly to the government, he bought government bonds at a discount and resold them to investors at a markup. He created a secondary market. Here's how it worked. The government needed money for war. Nathan provided it immediately in exchange for bonds. Then he sold those bonds to pension funds, insurance companies, wealthy individuals, anyone with capital looking for a safe return. The government got its money fast. Rothschild collected the spread between his purchase price and selling price, and investors got a tradable asset that paid interest. Everyone won, except the taxpayers, of course, who paid the interest that made the whole system function. But here's where the story gets darker. Rothschild didn't just finance governments. He positioned himself so governments had no choice but to use him. The legend of Waterloo has become almost mythical, and historians debate the details. But the documented facts are striking enough. In 1815, at the Battle of Waterloo, Nathan Rothschild allegedly learned of Napoleon's defeat before anyone else in London. His courier network was faster than official government channels. Some accounts say he used carrier pigeons. Others say he employed a private fleet of ships. Whatever the method, the information reached him first. What he did with that information varies depending on the source. The most dramatic version says he sold British bonds, signaling that Britain was losing. Prices collapsed. Other investors panicked and sold. Then, after prices crashed, Rothschild bought massive quantities at rock-bottom prices. When news of British victory arrived the next day, bond prices surged. Rothschild made millions. Historians note that his actual breakthrough came through government financing deals, exchange rate transactions, and bond price speculations. But the Waterloo story, whether fully accurate or embellished over time, captures the essence of the Rothschild model. Control the information. Control the issue. Control the market. By 1820, the Rothschilds dominated European sovereign debt. If a government needed to borrow, they went through the Rothschilds. Not because the Rothschilds were the only option, but because the Rothschilds controlled the investor network. They had the distribution. They set the terms, and they had something even more powerful. They had trust. When Nathan Rothschild issued a bond, investors bought it without hesitation. The Rothschild's name was the guarantee. This meant governments needed the Rothschild imprimatur to borrow at reasonable rates. Without it, they'd pay much higher interests, because investors demanded a premium for uncertainty. Here's why this matters for the debt trap. Before Rothschild, governments could theoretically refuse to pay. If a king defaulted, his creditors lost money and the system reset. It was painful for everyone involved, but it was contained. Default was embarrassing, but survivable. Rothschild made sovereign debt tradable across borders. A British bond might be owned by a French investor who sold it to a German bank who used it as collateral for a loan to an Austrian aristocrat. The web of ownership became so complex that defaulting wasn't just refusing one creditor. It was collapsing an entire international financial network. This is the Rothschild innovation. Make debt so interconnected that default becomes impossible. Not because governments are responsible, not because they care about their creditors, but because default would trigger systemic collapse. Governments became trapped. They had to keep paying, and they had to keep borrowing to pay the interest on old debts. The debt trap was no longer just permanent. It was inescapable. The Rothschild family wealth peaked in the mid-1800s. They were the richest family in the world, richer than any king, and that wealth came from one source: interest on sovereign debt. They didn't produce anything. They didn't build anything. They lent money to governments and collected interests forever. The system Paterson created in 1694, Rothschild industrialized by 1815, and every government in Europe was caught. But Europe was just the beginning. The real expansion of the debt trap came in America, and it came through a meeting so secret that its participants denied it happened for over 20 years. By 1900, America was becoming an economic powerhouse. Factories churned out steel, railroads crossed the continent, and new industries from petroleum to electricity promised endless growth. But America's financial system was primitive compared to Europe. Banks operated independently with no coordination. The money supply was tied to gold, which made it inflexible. There was no central mechanism to manage debt or respond to crises, and crises came regularly. 1873, 1884, 1890, 1893. Each decade brought another panic. Banks failed. Businesses collapsed. Ordinary people lost their savings. But the panic of 1907 was different. It started with the failure of the Knickerbocker Trust Company in New York. Depositors panicked. Lines formed outside banks as people rushed to withdraw their savings. Other banks, even healthy ones, faced runs as fear spread. The stock market crashed. Credit froze. The economy seized up. And there was no government institution to respond. No Federal Reserve. No lender of last resort. Just chaos. Into this void stepped John Pierpont Morgan. J.P. Morgan was already the most powerful banker in America. His bank financed railroads, steel companies, and industrial consolidations. He was feared and respected in equal measure. During the 1907 panic, Morgan personally organized a bailout. He gathered the major New York bankers in his private library on Madison Avenue. He locked the doors, and he forced them to pledge their own money to stabilize failing banks. The meeting lasted all night. By morning, Morgan had extracted commitments totaling $25 million from the assembled bankers. The panic subsided. The economy stabilized. Morgan had single-handedly saved the American financial system, but he was 70 years old. He knew he couldn't do it again. His health was failing. His influence, while enormous, was mortal. So Morgan and his associates, the most powerful bankers in America, designed a permanent solution. They needed a central bank. There was just one problem. Americans hated central banks. The first Bank of the United States, created by Hamilton in 1791, had been shut down in 1811 after its charter expired. The Second Bank of the United States, chartered in 1816, was killed by Andrew Jackson in 18. Populist opposition to central banking was fierce. The memory of concentrated financial power of Eastern elites controlling the money supply was still fresh. Any proposal that looked like a central bank would face immediate opposition, so Morgan's group disguised it. In November 1910, a small group of men boarded a private rail car at a New Jersey train station. They were instructed to come alone, to use only first names, to tell no one where they were going. Their destination was Jekyll Island, Georgia, a private resort island owned by some of America's wealthiest families. The Jekyll Island Club's members included Morgan himself, the Rockefellers, the Vanderbilts, For 9 days, 6 men met, in secret at the clubhouse. They designed the structure of what would become the Federal Reserve System. Who were these 6 men? Senator Nelson Aldrich of Rhode Island, father-in-law to John D. Rockefeller Jr., chairman of the Senate Finance Committee, the most powerful figure in Congress on monetary matters. Abraham Pyeth Andro, Assistant Secretary of the Treasury, an academic economist who provided theoretical expertise. Henry Davison, senior partner at J.P. Morgan and Company, Morgan's right hand. Man, Arthur Shelton, Aldrich's secretary, brought along to handle logistics. Frank Vanderlip, president of National City Bank, the largest bank in America at the time, represented Rockefeller interests. And Paul Warburg, a partner at Kuhn, Loeb and Company, born in Germany, an expert on European central banking who had studied the Bank of England and the German Reichsbank extensively. The meetings were kept secret because the participants knew exactly how the public would react. If word got out that Wall Street bankers were designing America's monetary system, no plan they produced would ever pass Congress. So they lied. Participants told family members they were going on a hunting trip. They used fake names on the journey. They avoided being seen together in public, and they didn't admit the meeting happened until the 1930s, more than 2 decades later. The plan they produced was brilliant political manipulation. The Federal Reserve wouldn't be called a central bank. It would be called a Federal Reserve System. Not one institution, but 12 regional banks. It wouldn't be controlled by Wall Street. It would be overseen by a board of governors appointed by the president. It looked decentralized, democratic, public-spirited, but the structure ensured banker control. The regional Federal Reserve banks were privately owned by member banks. Commercial banks that joined the system received shares in their regional Fed. Those member banks elected the boards of the regional Feds. And the regional Feds influenced the Federal Reserve Board. The government appointed some members of the Board of Governors, but the bankers controlled the system from within. And the most important power, the power to create money and buy government bonds, was given to the Federal Reserve Bank of New York, which was controlled by the largest Wall Street banks. Morgan's banks. The Federal Reserve Act passed Congress in December 19. Most representatives didn't fully understand what they were voting for. The bill was complex, technical, and sold as a reform to prevent future panics. And immediately, the debt trap expanded. Why? Before the Federal Reserve, there was a natural limit to how much the government could borrow. Banks only had so much money to lend. The gold standard constrained the money supply. If the government tried to borrow too much, interest rates would rise as demand for loans exceeded supply. At some point, borrowing became too expensive to continue. The Federal Reserve removed that limit. The Fed could create money by purchasing government bonds. Here's the mechanism, and it's important to understand precisely how it works. The government needs money. The Treasury issues bonds. These are IO, used from the government, promising to pay interest and eventually repay the principal. The Federal Reserve buys those bonds, but here's the key. The Fed doesn't use existing money to buy them. It credits the Treasury's account with newly created money. The Fed simply types numbers into a computer, or before computers, wrote entries in a ledger. New money appears. The government spends it, and the bond sits on the Fed's balance sheet. This is debt monetization. The government's debt becomes money. And because the Fed can create unlimited money to buy unlimited bonds, there's always a buyer for government debt. Always demand. The government never has to stop borrowing. It can roll over debt forever, because the Fed will always be there to buy. The interest payments flow from taxpayers to the banks that own the Federal Reserve System. Morgan died in 1913, the same year the Federal Reserve was created, but his legacy is the structure that makes the current $38 trillion in U.S. debt possible. Without the Federal Reserve, the government couldn't borrow at this scale. The market wouldn't support it. Interest rates would spike. Lenders would demand higher premiums for increasing risk. But with the Fed as a guaranteed buyer, there's no limit. The government can always find someone to lend it money because it can create that someone. The debt trap became infinite. By the 1970s, the system Paterson, Rothschild, and Morgan built was functioning globally. Every developed nation had a central bank. Every developed nation borrowed, rolled over debt, paid interest. The machine hummed along smoothly, but developing nations were different. They borrowed for infrastructure, for industrialization, for the basic machinery of economic development. Roads, dams, power plants, factories, and many couldn't keep up with their payments. The debt trap was reaching its limits. Countries that couldn't pay eventually defaulted. Creditors lost money. The system, while painful, reset. Then, Paul Volcker made the trap permanent. Volcker was appointed chairman of the Federal Reserve in August 19. He faced a problem that seemed insurmountable. Inflation was over 10% and rising. The dollar was losing value. Foreign governments were losing faith in American currency. The standard prescription was to raise interest rates. Higher rates discouraged borrowing and spending, cooling the economy and reducing inflation. Volcker did raise rates, but not modestly, not gradually. He raised them to 20%, the highest interest rates in American history. Inflation dropped. The dollar strengthened. Foreign confidence returned. Mission accomplished. But there was a side effect that would reshape the global economy. Developing nations had borrowed billions of dollars during the 1970s when interest rates were low. 5%, 6%. Affordable rates for countries trying to industrialize. Their loans had variable interest rates. When American rates rose, their payments rose too. Suddenly, countries that had borrowed at 6% were paying 18%, 20%. Their interest payments tripled. By 1982, Latin American debt reached $327 billion. Mexico owed $80 billion. Brazil owed $60 billion. Argentina owed $40 billion. And they couldn't pay. The interest alone exceeded their export revenues. They were earning less from selling goods to the world than they owed in interest on their loans. Something had to break. In August 1980, Mexican Finance Minister Jesus Silva Herzog made a phone call that shook the global financial system. He informed the Federal Reserve Chairman, the Treasury Secretary, and the International Monetary Fund that Mexico could no longer service its debt. Mexico was default. Now, you might think default would simply be Mexico's problem. The country couldn't pay. Creditors would lose money, and everyone would move on. That's how default is supposed to work. But remember, the Rothschild innovation. Debt had become interconnected. American banks had lent most of that money to Mexico. Citibank, Bank of America, Chase Manhattan, the 9 largest U.S. money center banks, had Latin American debts equal to 176% of their capital. When you included other developing countries, that figure rose to 290%. If Mexico defaulted, those banks would take massive losses. Some might fail. And if the largest American banks failed, the entire financial system could collapse. The debt trap had caught the bankers too. Volcker could have let it happen. Let the banks take their losses. Let the market clear. Let the system reset. Painfully, but completely. But he didn't. Instead, he orchestrated a bailout through the International Monetary Fund. The IMF would lend Mexico, Brazil, Argentina, and others enough money to keep making interest payments to American banks. Problem solved, right? Not exactly. The loans came with conditions. They were called structural adjustment programs, and they were brutal. Cut government spending, lay off public employees, reduce subsidies on food and fuel that kept prices affordable for ordinary citizens, privatize state assets, sell off national industries to foreign investors, telephone companies, airlines, utilities, anything that could generate cash, open markets to foreign investment, remove protections for domestic industries, let foreign companies compete freely, even if they destroyed local businesses, devalue currencies, make your country's money worth less, which made your debts even harder to repay in real terms. Basically, dismantle your economic sovereignty in exchange for the money to keep paying interest. And here's the key. The IMF loans didn't reduce debt. They just rolled it over, made it manageable but permanent. This is the VUCA. Innovation. When debt becomes unpayable, don't forgive it. Restructure it. Lend enough to keep interest payments flowing, and extract political and economic concessions in exchange. The debt trap became a tool of control. Countries that couldn't pay were forced to open their economies, sell their assets, and submit to foreign economic policy. In exchange for what? The privilege of staying in debt. This pattern has repeated for 40 years. Mexico in 1980, Argentina in 2001, Greece in 2010, Sri Lanka in 2022. Every time, the same structure. IMF loans, to keep paying interest. Austerity imposed. Sovereignty surrendered. Debt never eliminated, just restructured, made perpetual. Volcker died in 2019, but his legacy is the mechanism that ensures the debt trap is global and inescapable. Even when countries can't pay, they're not allowed to default. They're refinanced into permanent indebtedness, and the interest keeps flowing to the creditors. The same banks, the same institutions, the same system Paterson created in 60. Now, let me show you how these 4 architects built a system where debt is infinite and escape is impossible. Start with Paterson's model. Government borrows, pays interest forever, never repays principal. Add Rothschild's innovation, make the debt tradable globally. So it's not one creditor, it's a web. Default collapses the system. Add Morgan's mechanism, central banks create money to buy government bonds. Unlimited demand, government can always borrow more. Add Volcker's trap, when countries can't pay, restructure. Don't forgive. Keep the interest flowing. The result is what we have today. $315 trillion in global debt. Government debt. Corporate debt. Household debt. None of it will ever be repaid. All of it pays interest. And all of it is connected through the financial system. So default anywhere threatens collapse. Everywhere. Let me show you the specific mechanisms. The US government has issued $38 trillion in debt. Who owns it? About 24 trillion, roughly 2/3, is held by the public. It includes domestic investors and foreign holders, private investors like pension funds, mutual funds, insurance companies, and banks. The Federal Reserve itself holds about 4.5 trillion. Foreign governments and investors hold about 8.5 trillion. Japan is the largest foreign holder, followed by China and the United Kingdom. The remaining debt, about 7 trillion, is owed to government trust funds, Social Security, Medicare. The government borrowed from these programs and spent the money. Now, it owes itself. But it's not really owing itself. It's owing future taxpayers. Because when Social Security needs to redeem those bonds, the government has to raise taxes or borrow more to pay. It's a shell game. But the interest flows regardless. Now, here's the number that should make your jaw drop. The annual interest on US debt now exceeds $1 trillion. $1 trillion per year. Flowing from taxpayers to bonds. Where does that $1 trillion go? To the institutions that hold the bonds. BlackRock, Vanguard, State Street, Fidelity. These asset managers control tens of trillions of dollars. They buy government bonds with other people's money. Pension funds, retirement accounts, insurance premiums, and they collect the interest. It's the largest wealth transfer in history. Continuous, structural, and invisible to most people because it's not called a tax. It's called debt service. But it's the same mechanism. Workers pay, institutions collect, and the debt never decreases. Scale this globally. Japan owes $9 trillion, mostly to Japanese institutions and the Bank of Japan. Europe owes $14 trillion, mostly to European banks and the European Central Bank. China has significant domestic debt held by state banks. Every country is running the same system, and they're all interconnected. Japan holds U.S. treasuries. The U.S. holds European bonds through various mechanisms. Europe holds developing nation debt through the World Bank. Developing nations hold reserves in U.S. dollars. It's circular. Everyone owes. Everyone. And the interest flows upward to the institutions that manage the debt. Here's why this can never end. If the U.S. paid off its $38 trillion, the money supply would collapse. Dollars are created when the government borrows. The Federal Reserve creates money to buy bonds. If the government paid off all its debt, those dollars would disappear. The Fed would sell its bonds back for dollars, and those dollars would be destroyed. The result, deflation, depression, economic collapse. So the government can never pay it off. It has to keep borrowing, keep rolling it over, keep paying interest. The same is true globally. If every government paid off its debt, the global money supply would shrink by 2. There wouldn't be enough money to conduct trade. The system would seize. Debt can't be eliminated. It's structural, necessary, by design. And here's who profits. The institutions that hold the debt. BlackRock manages over $10 trillion. Vanguard manages another $8 trillion. State Street manages $4 trillion. These three firms alone control more than $20 trillion in assets. They buy government bonds. They collect interest. They charge fees to the pension funds and retirement accounts whose money they invest. It's a perpetual profit machine, and it's funded by taxpayers who pay interest on debt that will never be repaid. Now, here's the final piece. The four architects didn't conspire together. They lived in different centuries. Paterson never met Rothschild. Rothschild never met Morgan. Morgan died before Volcker was born. But each one solved a problem in a way that benefited bankers, and each solution built on the previous one. Paterson made debt permanent in 1690. Rothschild made it global in 1815. Morgan made it infinite in 19. Volcker made it inescapable in 1980. Together, they built a system where governments borrow forever and pay interest eternally, and the people who control the bonds, who manage the debt, who collect the interest, they're the ultimate beneficiaries. Not governments, not taxpayers, the financial institutions. Here's the final truth. $38 trillion isn't a crisis for them. It's a business model. Every dollar of debt is an asset on someone's balance sheet. It pays interest. It provides collateral for more borrowing. It can be traded, leveraged, and as long as confidence holds, as long as people believe the government will pay interest, even if it never repays principal, the system functions. The debt trap is complete. Escape isn't possible. Not without collapsing the entire financial system. Let me take you deeper into how this system actually operates in practice, because understanding the theory is one thing. Seeing how it affects real economies and real people is something else entirely. Consider what happens when a government issues new debt. The Treasury announces an auction. It will sell, say, $10 billion in 10-year bonds. These bonds promise to pay a certain interest rate, let's say 4%, every year for 10 years. At the end of 10 years, the government promises to repay the principal. Investors submit bids. Banks, pension funds, foreign governments, hedge funds. They're competing to lend money to the U.S. government. The Treasury accepts the best bids, the ones offering the lowest interest rates. Money flows into the Treasury's account. The government spends it on whatever Congress has authorized. Military, Medicare, Social Security, infrastructure, salaries. So far, this sounds like a normal transaction. Someone lends money, someone borrows it. Everyone's happy. But here's what happens beneath the surface. Many of those bidders didn't use their own money. They borrowed it. A bank might borrow from the Federal Reserve at the Fed's policy rate, then use that borrowed money to buy Treasury bonds at a slightly higher rate. The spread between what they pay the Fed and what they earn from Treasuries is their profit. Risk-free profit, essentially, because Treasury bonds are considered the safest assets in the world. Where did the Fed get the money it lent to the bank? It created Italiano out of nothing by typing numbers into an account. So the chain works like this. The Fed creates money, lends it to banks. Banks use it to buy government bonds. The government spends it. Taxpayers pay interest on the bonds. That interest flows back to the banks. The banks pay back the Fed with some of the interest and keep the rest as profit. At no point did anyone produce anything. No factory made a product. No farmer grew a crop. No worker provided a service. Money was created. Debt was issued. Interest was paid. Institutions profited. And the debt never goes away. Because when those 10-year bonds mature, when the government is supposed to repay that $10 billion, what does it? Though it issues new bonds, it borrows another $10 billion to repay the first $10 billion, plus whatever additional amount it needs to cover the interest. This is called rolling over the debt, and it happens constantly. The Treasury issues new debt every week. Some of it is new borrowing. Most of it is rolling over maturing debt. The principle is never repaid. It's just refinanced, extended, renewed, forever. Now let's look at how fractional reserve banking multiplies this effect through the broader economy. When you deposit money in a bank, the bank doesn't keep all of it in a vault. It keeps a fraction, maybe 10%, as reserves. The rest it lends out. Say you deposit $1,000. The bank keeps 100 in reserves. It lends 900 to someone else. That someone deposits the 900 in their bank. Their bank keeps 90. Lends out 810. That gets deposited. Bank keeps 81. Lends out 720, and so on. From your initial $1,000 deposit, the banking system creates roughly $10,000 in new deposits. New money, new spending power. All of it is debt. That $900 loan, it's debt. The 810, debt. The 729, debt. Every dollar in circulation, almost every dollar, was created through lending, which means every dollar represents someone's obligation to pay interest. When you hear that the money supply is tied to debt, this is what it means. Money is debt. They're the same thing. And this is why the system can never contract without causing catastrophic pain. If people started paying off debts faster than new debts were created, the money supply would shrink. Less money in circulation means prices fall. Wages fall. Asset values fall. But debt obligations don't fall. You still owe what you owe. This is deflation, and it's devastating. Businesses go bankrupt because they can't cover their fixed debts with falling revenues. Banks fail because their loans go bad. Unemployment soars because businesses are failing. A vicious cycle that feeds on itself. The Great Depression was, in large part, a deflationary spiral caused by contracting debt and money supply. So the system requires constant expansion. More debt, more money, more interest payments. Not because anyone is evil, but because that's how the machinery works. Stop it, and everything breaks. This is the trap. Not a conspiracy hatched in a smoky room, a structural feature of the financial architecture that has evolved over 3 centuries. Let me show you how this plays out internationally. After World War II, the United States held most of the world's gold and produced most of the world's industrial output. The Bretton Woods Agreement established the dollar as the world's reserve currency. Other countries would hold dollars instead of gold. The dollar would be convertible to gold at $35 per ounce. This gave the U.S. an extraordinary privilege. It could print the currency that everyone else needed. If France wanted to buy oil from Saudi Arabia, it paid in dollars. If Japan wanted to buy machinery from Germany, dollars. If Brazil wanted to import electronics from Korea, dollars. Once debt becomes permanent, institutions grow up around servicing that debt. Banks, bond traders, rating agencies, financial media, central banks. They all depend on the system continuing. They don't meet in secret to decide how to trap governments. They don't need to. Their individual interests are aligned. More debt means more interest payments, means more business, means more profits. And anyone who threatens the system, any politician who suggests defaulting, any economist who proposes alternatives, gets marginalized. Not through conspiracy, through the ordinary operation of power. The media, which depends on advertising from financial institutions, doesn't give much airtime to radical critics of the debt system. Politicians, who depend on campaign contributions from financial interests, don't propose policies that threaten those interests. Academics, who depend on grants and prestigious appointments that flow from established institutions, don't publish papers that fundamentally challenge the system. It's not censorship, it's incentives. The system defends itself by rewarding those who support it and ignoring those who don't. Let me show you the scale of what we're talking about. The United States pays about $1 trillion per year in interest on its national debt. That's more than the entire defense budget. More than Medicare. More than any other single program. $1 trillion flowing from taxpayers to bondholders every year. Where does that money come from? From you. From your income taxes. From sales taxes. From every revenue source the government has. Where does it go? To the institutions that hold treasury bonds, pension funds. Which sounds benign until you realize that pension fund managers charge fees that come out of retirees' returns. Mutual funds, which charge expense rate. Banks, which pay their executives and shareholders. Foreign governments, which use their returns to fund their own operations. The money flows up from workers who pay taxes to institutions that hold bonds. And because the debt is never repaid, this flow continues forever, not as a temporary measure to fund a war or build infrastructure, as a permanent feature of the system. Your great-grandchildren will be paying interest on debt incurred before they were born. Actually, they'll be paying interest on debt incurred before their great-grandparents were born, because the debt just keeps rolling over. Refinanced, extended, never eliminated. Now let me show you why conventional solutions don't work. Some economists argue that debt doesn't matter because we owe it to ourselves. Americans hold most American debt. The interest payments are just transfers within the economy. This argument ignores distribution. Yes, Americans as a group both pay and receive the interest, but the paying and receiving groups are different people. The people who pay are taxpayers. Everyone who works and pays income tax. Everyone who buys products and pays sales tax. The people who receive are bondholders, pension funds, insurance companies, banks, foreign governments, the wealthy individuals who own the institutions that own the bonds. The transfer goes from workers to owners, from labor to capital, from young to old, from those who earn income to those who own assets. Saying we owe it to ourselves ignores this entirely. Other economists argue that government debt isn't like household debt. A household can't print its own money. The government can. Therefore, the government can never really go bankrupt. This is technically true, but misses the point. Yes, the government can print money to pay its debts, but doing so causes inflation. Each dollar becomes worth less savings. Wages lag behind prices. Inflation is a hidden tax on everyone who holds dollars. It redistributes wealth from savers to borrowers, from the old to the young, from the cautious to the reckless. When the government inflates its way out of debt, it's not solving the problem. It's transferring the burden to a different group of people, and the institutions that hold the debt know this. They demand inflation protection, inflation indexed bonds, higher interest rates to compensate for expected inflation. The system adapts to protect creditors. Still, other economists suggest that as long as economic growth exceeds interest rates, debt is sustainable. You can grow your way out. This works mathematically, but ignores what happens when growth slows. When recessions hit, when interest rates spike, the United States has been able to carry its debt because it has been growing and because interest rates have been low for decades. But interest rates are no longer low. As of now, the government pays over 4% on new debt. If the entire $38 trillion had to be refinanced at current rates, interest payments would consume even more of the budget. And growth is not guaranteed. Demographic changes, resource constraints, climate disruption, all could reduce future growth rates. The math that looks manageable today could become impossible tomorrow. The fundamental problem remains: debt that grows faster than the ability to service it eventually becomes unpayable. But unpayable doesn't mean it goes away. It means it gets restructured, refinanced, inflated Hawaii imposed on future generations. The trap holds. Let me show you what alternatives exist and why they're not implemented. Sovereign money creation. Instead of borrowing from private institutions, governments could create money directly. No debt, no interest, just currency issued by public authority. This was how money worked for much of history. Kings minted coins from precious metals. The value is in the metal itself, not in a promise to pay. Some propose returning to this model with modern updates. Central banks would create money and give it to the government to spend, rather than lending it into existence through bond purchases. The interest savings would be enormous. That $1 trillion per year could go to public services instead of bondholders. But this would threaten the entire financial industry. Banks profit from interest. Asset managers profit from managing bonds. Traders profit from buying and selling debt instruments. They would fight any such proposal with every tool at their disposal. Campaign contributions. Media campaigns. Economic studies showing why it would cause hyperinflation. Whether those warnings are valid or self-serving is debatable. But the political power to overcome them doesn't exist. Not when the financial industry funds political campaigns and employs legions of lobbyists. Public banking, instead of private banks creating money through loans. Public banks could do the same thing but return profits to the public. North Dakota has had a public bank since 1919. It partners with private banks, offers low-interest loans, and returns profits to the state treasury. It's been successful for over a century. But when other states propose similar institutions, the private banking industry fights viciously. They argue it's socialism, government overreach, inefficient, prone to political interference. Whether these arguments have merit or not, they're effective politically. Public banking remains rare. Debt jubilee, periodically forgiving debts, as was practiced in ancient Mesopotamia and biblical times. Every 50 years, the slate was wiped clean. Debts cancelled. Slaves freed. Land returned to original families. This prevented the accumulation of permanent debt servitude. It reset the system before inequality became too extreme. Some propose modern versions. Cancel student debt. Cancel medical debt. Restructure mortgages, but every debt forgiven is an asset destroyed. Someone owns that debt. Pension funds, banks, investors. Forgiving it means those entities take losses. They resist. And their resistance has political power. The trap holds. Let me show you where we are now. Global debt stands at $315 trillion, about 250% of global GDP. The highest ratio in history. Government debt is about $100 trillion. Corporate debt is higher. Household debt adds more. Interest rates, after being near zero for years, have risen. This means interest payments are rising too. Governments that borrowed cheaply are now refinancing at higher rates. The U.S. deficit, the gap between what the government spends and what it collects in taxes, runs about $2 trillion per year. That deficit is financed by new borrowing, which adds to the debt, which increases interest payments, which increases future deficits. It's a spiral, and there's no obvious way to stop it. Cutting spending is politically difficult. Every program has beneficiaries who vote. Defense contractors, Medicare recipients, Social Security beneficiaries, federal employees. Raising taxes is politically difficult. Every tax increase has losers who vote, and who donate to campaigns, and who fund lobbying. Growing out of it requires sustained high growth that may not materialize. Inflating out of it imposes costs on savers and fixed-income recipients. Defaulting triggers the consequences we've seen in Argentina, Greece, Sri Lanka. Every option is painful. The least painful option is to keep doing what we're doing. Borrow more. Roll over the debt. Pay the interest. Kick the can down the road. This is what every government does, because the alternatives are worse in the short term, and politicians operate on short time horizons. Elections come every few years. The consequences of accumulated debt come later. The trap holds. Let me bring this back to the four architects and what they built. William Paterson in 1694 established that government debt could be permanent, that interest could flow forever, that the principal need never be repaid. Nathan Rothschild in the early 1800s established that government debt could be global, that it could be traded across borders, that default would threaten not just one creditor but an entire international network. J.P. Morgan and his associates in 1913 established that government debt could be infinite, that central banks could create unlimited money to buy unlimited bonds, that there would always be a buyer for government debt. Paul Volcker in 1982 established that government debt was inescapable, that countries which couldn't pay would be restructured, not forgiven, that the interest would keep flowing no matter what. Each innovation built on the last. Each made the system more robust, more comprehensive, more difficult to exit. And here we are, 331 years after the Bank of England was founded, still paying interest on debt that will never be repaid, still trapped in a system that extracts perpetual payments from workers and transfers them to owners. This isn't what they teach you in school. In school, they teach you that debt is a problem to be solved, that responsible governments balance their budgets, that if you work hard and pay your taxes, you're doing your part. But the architects knew better. Debt isn't a problem. Debt is the foundation. Interest isn't an unfortunate necessity. Interest is the rent we pay to live in their system, and the system was designed, through 3 centuries of accumulated innovations, to ensure that the rent never stops. I want to be clear about what I'm not saying. I'm not saying there is a secret group of bankers who meet annually to decide the fate of nations. That's conspiracy thinking. That's not how power works. Power works through institutions, through incentives, through the ordinary operation of self-interest by millions of people who are just doing their jobs. The banker who sells treasury bonds isn't evil. He's earning a living. The pension fund manager who buys those bonds isn't part of a conspiracy. She's trying to generate returns for retirees. The congressman who votes for more spending isn't corrupt. He's responding to constituents who want services. Each person acts rationally within the system, and the system produces the outcomes we see. Growing debt, perpetual interest payments, wealth flowing from those who work to those who own. No conspiracy is necessary. Just incentives, institutions, and 3 centuries of accumulated structure. And that's actually scarier than a conspiracy. Conspiracies can be exposed. Conspirators can be arrested. But a system that perpetuates itself through the ordinary self-interest of millions of people. How do you fight that? Here's what I know. Understanding the system